Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to do Valuation Considerations Part 2. And it starts with this premise that good valuation is what's going to determine your return in a stock. And for purposes of this video, we're focused on two variables, the correct time frame and the correct valuation metrics, which is what we're going to get into in today's video. And the key here is that it's about simplicity and ranges when you're developing your valuation work. So let's start with looking at three well-known ways of valuation. The first is discounted cash flow, or DCF, which can be relatively complex. Number two is relative valuation, think your comp set. And number three is other metrics, or the rule of 40 or 50. And in today's video, we're going to focus on numbers 2 and 3, because again, DCF can be complex and can be fraught with a lot of issues around different variables. So what are the three most common types of relative valuation metrics? Well, they're all enterprise value based, and they start with an enterprise value to sales, enterprise value to EBITDA, and enterprise value to free cash flow. The old line relative valuation metrics are your price to earnings ratio and your price to book ratio. So these are 5 really easy ways that you can calculate a valuation of a stock. And the question is, how do you determine the over or under valuation of the stock in question? Well, here's a simple method. First, take an average of the 5 calculations that you did and compare it to the current stock price. Number 2, look at the range of the 5 calculations. And it's going to tell you a lot. Is the range narrow? Is it wide? Is there a large cushion between the current stock price and the average value? And a lot of this is going to tell you whether there's more going on under the hood, meaning there are issues in the underlying business that investors believe or disbelieve, or other debates that you need to do more work on to truly understand the actual over or under valuation of the stock. And lastly, this is the idea: avoid a valuation that goes to 5 decimal points. Even 2 decimal points is too precise. You want ranges, because you're never going to know if the stock is actually going to hit $27.32. But you will know that if the stock is worth 25 to 28, if the stock breaches 25, you should be looking to sell that stock. So let's close with a quick look at the rule of 40 or 50. And whether you try to get to 40 or 50 is all based on how aggressive you are in terms of your growth expectations. And the simple equation is your annual sales growth plus some sort of profit margin. It can be adjusted EBITDA margin, free cash flow margin, or cash from ops minus CapEx. And do these two numbers sum to 40 or 50? And that's what's going to determine your valuation. Now, there's 2 key takeaways for executives with the rule of 40. And the first is it's about balance. You don't want to be 100% growth, 0% profit, or 0% growth, 100% profit. And the way you perform on a rule of 40 or 50 metric should really be informing your business strategy. If you're over-levered to sales or over-levered to profitability, it's telling you to reinvest in that other lever in the business. Always here to help. Thanks for watching.